Doubts over a peace deal with Iran caused oil to rally and the markets to dip, but only slightly. And I was asked recently if this was the PPT. We'll talk about it and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about what's going on in the markets a little bit and take your questions. So the concept of the Plunge Protection Team, or PPT, officially the Working Group on Financial Markets, is a favorite target for conspiracy theorists because it provides a convenient boogeyman for market recoveries that feels somewhat inorganic. Now, over the course of the weekend, after last week ended a sort of profound rally in the markets, one would have expected that, considering that a significant portion of that was supposedly a form of resolution coming in the Gulf, that perhaps when the news was disappointing over the weekend and the ceasefire seemed to come to a grinding halt and there were ships turned back, that perhaps one of the things that was going on is that there's something else afoot, that something else was keeping the market up. And one of the things that was proposed to me was that it was the PPT, the Plunge Protection Team. And I was going to push back on that a little bit, but I thought maybe this would be a better format for that. So the logic in all of this is that there is government agencies, essentially, that working in conjunction with one another, look to create support for the market if it begins to dip too drastically. Now, to understand this, the working group for the financial markets, which followed the crash in 1987, it makes some sense that, in other words, that we had a material disruption in the markets. There was something functionally that sort of broke in 1987 that caused the markets to crash as violently as they did on that Black Monday. And of course, financial regulators and overseers should, and indeed the exchanges themselves, should indeed be keeping an eye on that. But the notion that those participants are actually there to sort of prop up the market during a systematic sell-off isn't really what's going on. For one thing, the U.S. equity market is tens of trillions of dollars. And so therefore, if the market is rolling over quite severely, it would require many hundreds of billions of dollars of liquidity into equities to create some measure of support for it. And there is no line item in the federal budget or the Treasury's accounts or the Fed's to make secret purchases of trillions of dollars in equities or equity futures or something like that. That's not to say that these organizations cannot step in one way or another. Of course, the Federal Reserve can and does use its balance sheet for the purchase of bonds. You can reduce interest rates. You can do other things to inject liquidity into the system. But generally speaking, when that happens, it's something that is transmitted to and communicated to the markets quite clearly. This is not something that sort of happens behind the scenes, which I think is kind of the suggestion that I've heard, that people think that there's some sort of dark forces that are existing in the outside that are stepping in and starting to buy stocks when they decline. Now, part of why there might be this perception is that in some markets that can happen. So outside of the United States, it is true that there are government agencies that can step in to buy equities in their local markets from time to time. And of course, in many countries, you also have sovereign wealth funds, for example, that hold big blocks of stocks, both foreign and domestic, and they may indeed, be doing something on that. But I think that this is one of those situations where if people are thinking, oh, there's a plunge protection team stepping in, or we have midterms coming up, this is not to say that politicians don't want things to be going better going into the midterms. We did see that there can be actions taken to manipulate the price of of certain things at times when an election is upcoming. The Biden administration did this in 2022 ahead of the midterms when they started selling off portions of the Strategic Petroleum Reserve to depress oil and gas prices that summer. And they sold off quite a lot of it. Some of that was repurchased by the end of Biden's term, but most of it was not. And it's one of the reasons why the SPR was at the lowest level coming into the current administration that it had been in 40 years. In fact, actually, you know what I'm going to do? Let's bring up a chart of that so we have a look and you can kind of see what was going on. So hopefully I have my screen share on. Strategic Petroleum Reserve. So here we are. This is the total inventory data. We can take a look at it here. I'll just put up a line chart. There we are. Okay. So you can see that some was repurchased, but let's just draw a line here so we can kind of get a sense of it. Let's just look until about, it would have been about November. I think that's about where we were. Yeah, it's right in here. Is that right around November or so? Yeah, that's the end. So that is basically the end of Biden's term. It was basically the same. We had the same amount in the SPR then that we did in March of '84. So in December of 2024, we had the same amount of oil in the Strategic Petroleum Reserve as we had in month ended March 1984. And you can see where this precipitous drawdown took place. It was right in there. And that was in advance of the midterm elections, which took place right there where I just drew that little red circle. Hopefully you can see that. So it's not beyond politicians to try to manipulate prices with an upcoming election, and that would be one of the more obvious ones. Now, of course, we might see drawdowns for quite a different reason, and that is because we are currently undergoing the biggest disruption to global oil supplies ever. So it's a little unfortunate, I think it's safe to say, that this whole thing kicked off while we were almost as ill prepared for it as we have been in half a century. So that is a little bit unfortunate. Now, the fortunate part is that U.S. consumption has not grown at the pace of U.S. GDP. So our sensitivity here in the United States is lower than it was 40 years ago. That's the first part that's good. Part of that is a function of deindustrialization. There's another potential reason why it's not as risky as it might have been at some point in the intervening period, and that is that the United States has rapidly and dramatically increased our oil and gas production. So a lot of people were concerned about peak oil for the longest time. We were big importers. The United States uses about 20 million barrels a day, and we now produce that much, or even a little bit more, of barrels equivalent. So, that does not mean we don't have to import some things and potentially export others. What that means is that if you just took a look at the total amount of energy that we pull out of the ground domestically versus how much we consume of fossil fuels domestically, that we actually have a surplus. So that's a good thing. Where we would need to trade, of course, is that it is in the specifics of the products that are being consumed where you might find some differences. So if in round numbers we say, and actually it's probably slightly less, but let's just say a quarter of a barrel of crude oil gets, once it's refined into product, gets refined into diesel, and about 50% of the 42 gallons in a barrel of crude oil gets refined into gasoline, and then you have other products like naphtha and so on. How much of each of those individual products any given country needs will vary depending on whether they have, a greater percentage of the automotive fleet is diesel powered, for example. In France, I think 50% or slightly more of the cars on the road are diesel. So their need for diesel relative to gas is slightly higher than it is in the United States. That sort of thing. Anyway, I don't think, as we look at this, that the reason that U.S. equities held up as well as they did today in light of the news, and I think we were only down about 13 handles, so 16 handles, it looks like it was about that by the close. It was 13 handles or so when I was looking at it, which is really quite a de minimis downswing when you consider two things. One, just how sharply the U.S. Equity market had rallied off of those lows. We're going to take a look at that now. You can see that for those that follow something like RSI, you can see that arguably we were already in a slightly overbought condition. You can see just the series of up days we had in a row. I think somebody was telling me that you could count on one hand the number of times that we have seen a rally that strong in U.S. equities in a century. So maybe one of 5 instances or something where we'd seen a rally as sharp as this one. So to what might we attribute this? Part of it is that arguably we could say, well, for one thing, the market was oversold here in late March, early April. That's one possibility. Another possibility is, and when we do get oversold, what's going on there? Maybe we should just talk a little bit about that too. And part of the reason why some people, I think, believe in this PPT, this plunge protection team idea, and that is that in times of market distress, you might see that a lot of investors are under allocating to equities. In other words, you start to see things rolling over, and you say, "Oh, I'm not going to rush in and buy right now. I will wait." And that patience to deploy capital can be true for individual self-directed investors. It can also be true for institutional investors who might continue to see some capital inflows and undeployed cash, but they elect to wait and see and bide their time. Now, because in general, the flows of capital vis-a-vis the U.S. equity markets is largely into them, meaning that every 2 weeks people get a paycheck. Some of their paycheck comes out and goes into their 401k, for example, and some of that money finds its way into equities. That in general, there's more going in inflows than there is coming out. And if there's a slowdown in whether or not that capital inflow is immediately deployed, you can end up with an increasing cash cushion of undeployed capital, which is a little bit of pent-up demand. And I think that pent-up demand, once it starts to get deployed, and I think that's probably what happened off of those March lows, is that there was a lot of capital that was not getting deployed since the conflict broke out on the 28th. People were sort of waiting, biding their time, and cash balances were increasing. And then once the market starts to go higher, people are saying, okay, well, I guess that signals the all clear. And then you also have a little bit of a FOMO thing going on where people are a bit concerned and don't want to be under allocated for too long. It's one thing to say, okay, well, we're not going to deploy it today or in the next 2 or 3 days. But once you start getting into weeks and you have a cash balance going, it is not in the position of most professional investors to say, okay, well, we're going to sit here in cash. You want to be allocated. That's one part of it. The other part, of course, is earnings. And that is that we are now well into earnings season. And at least on the portion of that trade, and I'm going to customize this a little bit. So what I'm going to do is we're going to just take a quick peek at names that have been reporting, and I'm going to start this a little bit later. I don't want to start it before. And actually, you know what? Let's just see when Delta, I think, was. We'll start with Delta's earnings date because that was kind of the kickoff. So that was on the 8th. So we're going to start. We're going to look from, you know what? Let's just go from March 1st. Why not? I mean March 1st, April 1st. So that's after the strikes. We'll take a look at all the companies that have reported and see what kind of results we're getting. So update, please. There we go. So we can see that 136 companies out of 2765 that are anticipated to report between April 1st and May 15th. That in general, we have seen positive sales surprises. We have seen positive earnings surprises, 4.5%. Biggest we've ever seen? No. By the way, if you're looking at this and you're saying, okay, well, how do I translate this? Think of these colored bars as just the percentage. In other words, how many companies actually came out with a better than expected sales or revenue number, how many came out with a worse than expected sales or revenue number, and which came in essentially right on the number. And what we can see here is that about 57.4 came in better of the 136 that reported so far, and another 9.25% came in line. So if you just do a little quick arithmetic there, and you say, okay, about 2/3 of the companies that have reported so far, and this is a relatively small percentage, right? So we're only dealing with 136 out of 2,765 names during the period that we're studying at the moment. But what you're seeing is that about 2/3 were either in line or better than expected. On the earnings side, these numbers look still a little bit better. So we've got 78 that came in with a positive earnings surprise, 6 came out in line, and 22, or only 20%, or closer to 21, came in with a negative earnings surprise. So that means that 79, almost 80% of the 136 companies that have reported so far this particular earnings season, the way I'm defining it, starting on April 1st, actually came out with better than equal to or better than expected earnings. So I think that has something to do with it. Now, let's talk about a name that's going to be reporting this week that I'm kind of interested in, and that would be Tesla. One of the things that occurred to me, and this is going to be more about the guidance type of numbers. This is not a cheap company by any sort of conventional historical measure of cheapness or value, right? So it doesn't really have a close comp that we can take a look at in terms of price to sales, price to earnings, that sort of thing. Certainly, you can't compare it to the legacy automakers. And in addition to that, I don't think many people who are looking at this company, whether they're long or short it, are really thinking about it in that sense. But it has occurred to me that still the company will trade with some correlation to their unit sales, their vehicle sales numbers. And I have been wondering whether there has been some increased interest, just as people are beginning to recognize that there is some sensitivity to, some vulnerability to gasoline prices for Tesla's EVs. And I mention that because this is all taking place at just about the same moment that many legacy automakers have announced that they are either not continuing or significantly downscaling their EV business. So whether that's Ford or General Motors or BMW, a lot of these legacy automakers have said that, and look, not an easy business, and for them it hasn't been profitable. So most of those companies were not able to sell EVs at a profit. Most people who look at Tesla are probably thinking about it in terms of FSD. They're thinking about it in terms of the cyber taxi. They are thinking about it in terms of robotics. But, whether or not they're going to sort of lead the charge, there is a meaningful amount of the company's financial flexibility that's going to come from the success of them continuing to do what they're best known for, and that's selling electric vehicles. And I wonder whether, with higher oil prices, some people who might be in the market are saying, you know what, when gasoline was $2 and change a gallon, which it was because I was in Austin, Texas in January, and I rented a vehicle which I refilled just outside the entrance to the Austin Bergstrom Airport for $2.07 a gallon, and I recently just filled the tank of my car at over $6 a gallon. Now, California's prices, Texas prices, very different. But let's just say that the appeal of an EV went up considerably in my eyes in just a few months as I became a little bit annoyed going to the gas station to refill. And I'm sure I'm not alone in that. So, with that in mind, I thought we might also then take a quick peek at the kinds of flows that we've been seeing in Tesla going into the print, because the implied move here is actually relatively low. So let's just take a look at some of the historical moves that the stock has seen. I'm going to incorporate, you know what, we'll go from 1 day prior. Really, I'm going to go from 2 days prior, because they report on Wednesday after the close. 2 days prior to 2 days after. The average move is 9%. Now, right here, you're going to see that Bloomberg is implying a move of about 1%. We're not really interested in the 1 day implied move because, as it happens, we have options that run until the end of the week. And we can see exactly what the options market is implying for the end of the week move. When I was looking at this earlier today, it was about 24.25. Let's see where we closed. We want to get rid of that option. We don't care about the options that expired today. This is one of the names that has intra-week options, incidentally. So stock around and landed 392.5, spot on the number, and came in a little bit, right? So I said it was about 12.25. 24.25 was where that straddle was priced when I was looking at it earlier today. It's less than $24 now. So the puts are offered at 65.35 cents inside, and those are 40.75 cents inside. So closer to 23.5 is the expected move by the end of the week. About 6%. Still, compared to the average historical move that we saw, relatively cheap, probably because the last few quarters have been relatively light. The trade that I saw that I thought made kind of good, interesting sense to me as I was looking at it, most of the activity for options expiring at the end of this week that we saw last Friday were the 400 strike calls that expire on this Friday. So those are 8.55 right now. 8.50. Let's just call it $8.50. Or about less than 2.2% of the current stock price. Upside break even of less than 410. So for anybody who is thinking, might options be cheap enough to make a long premium bet? Not something I usually favor doing because time is not on your side. Might that be a way to do it? And this right here is actually an illustration. I'm going to blow this up a little bit. Hold that. This is an illustration about how that trade would have worked out if you had done it in prior earnings for Tesla. So this is actually auto-adjusting, so it's taking that strike and that price. And you can see that you would have made money in this trade less often than you would have lost it. In fact, I figured out that it was 30% of the time. So only 3 times out of 10 would you have been profitable if you did this trade. Now, you would have lost a little bit of money each time you were wrong, but a few times you made considerable amounts if and when and as you were right. And what I figured out was that the average expected value, so taking all those losses and all those wins and then dividing by the 44 quarters that were looked at in this particular series, that trade, those calls were worth on average about 4.5% of the current stock price. So if you're spending considerably less than 4% to make that bullish bet, you will lose more often than you make money, but the amount you make when you do win was so much higher. And you can see that it was not, this is a little bit confusing when you look at a time series because I just want everybody to know this. This is the most recent data right here. So if you look down here, it's probably hard to make out. That's October 25. This was January of 2026. But my point is that you can see that the wins were, sort of interspersed at various times throughout the years. I mean, this one is 10 years ago. and this one was 1 year ago, right? So the point being that if you were going to trade options at this premium, you were better off being long than short. Now, the other thing you should take away from that is that normally I like to see people short premium in general. This is maybe not the best time for that by my work, just because the options simply don't price in that much volatility. Okay, so having said all of that, actually, here's a question. So it's a good one. Is the EV credits thing still a thing for Tesla? Yeah, so is it still a thing? It's not still a thing. So for a long time, a big source of Tesla earnings was credits. So there were both carbon credits the company could trade, and the other portion of that was that EV credits, so federal sales tax credits, that you could get if you picked up a car, helped propel sales. Now, the way the second part was written initially, there was a scale. So after you sold a certain number of cars, so the logic of the federal tax credit for individual purchasing EVs or PHEVs, so like the basically the partial zero electric vehicles, was that you could get up to a $7,500 federal tax credit. In some local jurisdictions, the number could be more. The problem was that that's phased out after you got to a certain number of sales. And it was only Tesla, because they basically crushed it in the EV space, that phased out their credits. So they were actually competing during a period of time when purchasers or lessors of Tesla vehicles would not receive a federal tax credit against companies that still would. So that put them at a relative or competitive disadvantage. So that was a problem. Then it came back, then it went away again. So they don't really have the benefit of getting cars out the door with effectively what amounts to a subsidy. I would argue that it probably is unnecessary. The fact that the company was able to continue to sell, I think they had, 352,000 unit sales in the most recently reported period, that they were able to still have good unit sales and still maintain some profits even without that, even as some of their competitors were unable to generate any profits at all, selling subsidized vehicle, I think speaks well of Tesla. It's unrealistic to assume that an amount of that size doesn't end up hurting sales. So that's on the federal tax credit for purchasers of cars side. But the other part of it is that there is a lot of trading that goes on in, just for basically carbon between businesses. So companies that, all the companies are trying to get inside of certain thresholds, and you can exchange carbon credits inside, basically to reduce your footprint. So if one company has a better footprint, they can essentially trade off with one that has a less desirable carbon footprint. And this was another important source of, and that's not necessarily related. That's not like on a per car $7,500 credit thing. That's just General Motors is selling too many carbon intensive vehicles, and they can do trades with Tesla, which is selling none, at least by way of how the regulators do those calculations. And so that was an important part of their business. So I think that it is important to remember that. But again, I don't think that Tesla is really priced on that either. Is it a little bit of a kicker? Yes, but I don't think that you could possibly get to the kind of valuation, which we might as well take a look at, just for comparison's sake. So this is Tesla's financials. These are not the way they report them, but it's just a standardized way that Bloomberg reports it, sort of the highlight numbers. But I think this is kind of a good way to do it. It's illustrative because it'll make it easier the reason you do that is it's just easier to compare like companies rather than going through the idiosyncrasies of how one company decides to report things versus another. Of course, it always makes sense to drill down a little bit just to make sure numbers are right. But you're dealing with a company right now that is trading at, as you can see here, about 14 times revenues. 14 times revenues for the full year. And if we're looking at, let's just take a look at it this way. So I'll do 1472, 829.6, and 6,450,000,000. A modest 228 times adjusted net income. Compare and contrast that with, I don't know, let's just pick Ford. So we'll put Ford in here, and Ford, by contrast, is trading, remember what I said before, 14 times revenues was the prior number. Now, you've got 0.285 times revenues. And as you can very easily see, because you can say, okay, well, for the full year, they're expected to do $1.52 in adjusted net EPS, trading at $12.87. So this thing is trading less than 10 times earnings. In fact, let's see what that is exactly. Why not? 8.5. So one's trading at 228.5 times earnings. The other one is trading at 8.5 times earnings. So not really easy to compare these two. But I do think that it's just worth noting, if you had looked at valuation as how you were going to decide whether or not you were going to buy Tesla. I decided many years ago, after a couple of times seeing the valuation for Tesla, before it was anywhere near the company it is today, thinking, oh, this is just ridiculous. Why is this thing trading at these kinds of multiples? That's just not tenable. Long before it started comfortably exceeding the value of all of the automakers in the world put together, I started to think, you can't short this thing. And I still feel that way. And I want to emphasize that, sometimes you get to a point where it's very hard to make, it's hard to get to where a valuation comes from. Instead, it's more important to pay attention to whatever narrative seems to drive it, and then just focus on whether there's shifts to the underpinnings of that narrative. Because if you were going to try to value it like an auto business, you would not be a buyer of it. But I don't think it deserves to be valued like a legacy automaker. It clearly is not valued like a legacy automaker. So instead, you have to kind of look to the things that they're doing exceptionally well. You've got some benefits of AI, of FSD, of robotics, of all these other things going on in there that legacy companies simply don't enjoy. And to their credit, from an engineering and a business perspective, this is a company that was able to start building cars essentially from scratch in the state of California, which, if you're going to pick a place in the United States to do it, probably not the most cost-effective one to do it. And in the midst of all of that, they were able to sell these cars profitably. So I think that speaks very well of their approach to the products that they build and everything else, but the valuation's a little bit hard for us to get around. Yeah, so seven-figure mission, saying it's a tech company. Yeah, I mean, it is a tech company, but then again, so is Micron, so is NVIDIA, so is Microsoft. Alphabet's technically in the communications services sector, but I think a lot of us would also say that that is a tech company, and none of those companies have valuations that come anywhere close to this one. To put things in, just to keep it interesting, NVIDIA being the largest company in the world, why don't we just compare that very quickly? And so that is now trading January 27, close enough to December, we'll call it the same. So that one is trading at 24 times full year earnings, right? Which is about a market multiple. Micron and I understand why this is true, by the way. Micron is trading at, what do we got here? Less than 10. And if you're wondering about that and you're saying, well, how come? I mean, aren't they growing like mad? Yes, they are. And aren't they they see massively expanding margins? Yes, they do. Less than 8 times. So it's even cheaper than Ford if you're looking just ahead to full year earnings. The reason is that, the memory area that they are in is largely viewed to be a commodity under most circumstances. Memory, just because of the build out in data centers, has become in such high demand that the prices have just been shooting through the roof. And you can see this in other areas that demand it, that have nothing to do with data centers and have nothing to do with Micron stock per se. Perfect example: if I'm not recording this video to the camera that I'm on right now, but if I was, I would have a CF Express card in the camera, or I'd have an SD card in the camera. This particular camera takes both, or I have an SSD card plugged into it. Those things have all gone up by tremendous amounts. So much so that when I was looking at the prices of memory on SD cards and things like that, that I actually thought I was looking at a different kind of SD card. So some they have much higher bit rates for recording, and those ones are typically much more expensive. So you could have a 64 gig card or a 128 gig card, 256, 512, so on. But the bit rates matter. So, if you have a higher bit rate capable card, that's worth more money than a lower one. In any case, I was looking at the price of cards because sometimes this stuff just pops up in my stream or recommendations or B&H Photo or whatever sends these things along because of television and stuff like that. I use video equipment. I actually thought that I was looking at like V90 cards when I was looking at the prices of V60 and V30s. And that's just because memory is shooting up. And ProGrade, which I think is one of the companies that sells those things, they recently made an announcement. The NAB, which is I think it's the National Association of Broadcasters, they had a conference which just wrapped up in Las Vegas, and there were a lot of companies down there that were advertising their new products. I'll highlight Blackmagic because Blackmagic is an Australian-based company. They make everything from cameras and switchers and software, audio software, video software. They compete with companies like Intuit and Adobe. Intuit, I guess the financial product, but Adobe, which makes some of the software on that side. They compete with Apple in that area. They were talking about on the hardware side that they could not even assign a price to some of the hardware that they anticipate being available for purchase in May and June and July, because the price of memory, and their machines use them, is so volatile and going up so sharply that they were coming up with, we think it's going to cost $1,495 for this device, $2,795 for that device. I'm just coming up with numbers, but that was about the order of magnitude. But we don't know, because we don't know what memory is going to cost. So it's highly disruptive what's going on that side. So Great White Shark is saying Micron is cheaper than NVIDIA. Wow. Well, yeah, cheaper is a relative thing. The principal distinction I would make between these two businesses is that, thus far at least, NVIDIA GPUs have not been commoditized. NVIDIA GPUs are, they're unique. And so therefore they can ask what they want. The demand for what's going on in Micron just has to do with the rapid build out of these data centers, the huge increase in demand for RAM that this has had. And, that is something that could, once that huge surge in CapEx levels off, that is something that is likely to fall. And so this is a really important thing to remember about cyclical businesses. They always look most expensive at the bottom of the cycle, and they always look most expensive at the top of the cycle. And what I mean by that is, if you're taking a look at, say, John Deere, so you're looking at Deere tractors, that company will always look most expensive on a current price to earnings basis at basically the trough in the agricultural equipment purchasing cycle. So on the back of weak commodity prices, agricultural commodities in particular, and that's just because when the farmers aren't flush and they don't have a lot of excess money, they're not buying it. So if rates are high and commodity prices are low, kind of like a perfect storm for farmers, then you're not going to see big purchases of Deere equipment. On the other hand, when all those things, when rates are low, commodity prices are off the hook, you're going to see a lot of purchases. And so at the bottom, you might see it trading 30 times earnings, and at the top, you might see it trading 9 times earnings. And it's at the top, 9 times earnings is not what you want to buy, because that's just looking back on the best possible environment for them. And when it's trading 30, you're looking back on the worst possible environment. So it is also true for Micron Technologies. Micron Technologies right now is this is the highlight for the company. And you can actually see that. I mean, look, revenues for the year that ends August, for the fiscal year that ends in August, $109 billion in revenues. That is it's 4 times what it was only 2 years ago. And take a look at the margins. What were their margins 2 years ago when they did $25 billion in revenues? They had a adjusted net income margin of just over 3%. It's going to be 61.4. I'm just going to tell you that commodity businesses don't typically enjoy those kinds of margins for long. Now, the street seems to be looking for 66% margins next year, which is quite ambitious. They are looking for it to fall in future years. I mean, what is this? Really? $171 billion and an 83.3% adjusted net income margin is what the street's forecast for fiscal year 29. That just doesn't seem right. So something is wrong here. Either one of these numbers is wrong, or this number is way, way wrong. Because at least the way people are modeling this out, and this is just taking the consensus of all of those people that cover it and who put out a forecast. But honestly, $105 in adjusted EPS for fiscal 2029, that's really all you're looking at is 3 years from now, because their fiscal year ends in the middle of the year. It's trading 4 times the numbers. I don't know. That's awfully optimistic as far as I'm concerned. Let me just send that call into voicemail. Anil, breaking. Tim Cook is stepping down as CEO. Any effect on Apple short term? If there's a business I think that can withstand the change in CEO, Apple is probably it. You know what is interesting? And I'm guessing, look, I mean, he's very well thought of. And I didn't know that. So this is coming as news to... So Apple names Turnus as next CEO and Tim Cook to become chairman. This is not a big disaster. You can see that the shares are supposedly falling on this, but if that's true, I don't think that with Tim Cook as chairman, 271, falling. It's a relative thing. Stock's down $2, not even $2. So it's still up since Friday's close. Maybe it'll give a little bit more of that back, but I don't think that's going to make that much of a difference. I have to say that in Apple's case, I may have misjudged these guys a little bit. And one of the things that I misjudged was that I felt like they made a Halo product in many Apple devices. I thought they had sort of saturated or picked up as much market share as they might. And that's largely how I had been thinking about the business. So I really didn't anticipate seeing growth that was faster than, say, GDP growth. In other words, they were in a maturing industry, and that they might hopefully just be able to grow with global GDP in their respective markets. And then yet take a look at it. Right now, for the fiscal year ended September 30th of 2026, we're looking at year-on-year 12% revenue growth. That is considerably faster than GDP growth. And there's a couple things that are propelling this. One is that they got better than expected iPhone sales in China. And when we say better than expected, what that translates to, because that is faster than GDP growth in China as well, that means that they are taking market share. So that is an important element. 7 figures mission, another tech company just happens to sell phones. Well, they sell a lot more than phones because they are selling the services that those that have bought their phones or their iPads and everything else, that platform. And, increasingly, people sort of get tied into the ecosystem. Now, one of our producers, Jay, who's listening right now, he's an Android guy, but, we are iPhone people over here, and it is not that easy to pivot. And it ends up, it's just this slow creep where it just takes more and more of the everyday aspects of your life somehow become involved with it, whether it's because you're used to using Apple CarPlay or because you use Apple Pay and Apple Wallet, or it's because you have your music on there and you also have Apple TV, or because, there are some things on the technology side that Apple remains quite good at. Now, I know that they discontinued the Apple, the Apple Pro, Mac Pro, and things like that. But we should also remember that this is a company that has historically put together some pretty good hardware solutions, and I still think they're relatively well positioned. And that's in addition to the fact that just doing what they do, they enjoy phenomenal margins, which illustrates the demand that there is for their products over their competitors. So in fairness, I'm going to say that the company is still very well positioned, and I think I underestimated them. I may have even underestimated them on one of these live streams in the past, simply because I didn't expect to see that kind of growth. I didn't expect to see them. In fact, I actually thought they were going to lose share. That was my, so why are you listening to me? I thought they might actually lose share in the phone market in China, but that doesn't seem to be the case. So kudos to them. Okay. Tucker D. Dog says, how many people's first Tesla will be a robot? Supposedly they will be less than a car, of course. The truck was supposed to be 50,000. Yeah, so it is funny that you mention it. Although the truck, there was sufficient demand when it first came out. So the day the Cybertruck was announced, even as the presentation was ongoing, I put my name on the list and reserved one. So at the time they had 3 offerings. The top offering was going to be a tri-motor all-wheel drive Cybertruck. And I put my name on the list. People who've been watching this channel will know some of the story here. That, of course, it ended up taking ages before the things finally started to come out. In 2023, I was notified that I could take, that if I wanted to, I could take delivery of a Foundation Edition Cybertruck. Now, when I had put my initial reservation down, and if you did put one of those reservations down, so the way it worked was this: you could put down a reservation that was $100. Then, as they were starting to get production going, and they hadn't even sold them yet, but if you were on the short list, so if you were one of the people that reserved one like that first day, that first night, even before Elon stopped talking, you were then told to put down a deposit, which I also did. That was like $1,000, right? So I had $100, and then I put in another 1,000 because I was still expecting to get it. And then we were told that the first ones that were going to come out were something called the Foundation Series, and they sent me an email that said, okay, here's how much in addition you owe to take delivery. And I could take delivery as, I think, November of 23 or December of 23. It was in that neighborhood. Maybe it was a little sooner than that. Because I was then offered another opportunity to get a less expensive one in January of 2024. But I remember distinctly getting the email, and it says, to take delivery, you need to remit another $120,000 something dollars. And I was thinking, $120,000. I remember when I reserved it that the anticipated price for that truck was 60 something, maybe 69.9. But effectively, it was almost double the cost. And I said, I'm not going to do that. And what was the Foundation Series anyway, other than it had, it said Foundation Series on it and didn't give you any new or cool features. One thing led to another, and I ended up not taking it. I did offer it to a colleague at the time. I said, maybe you're interested. It was also, it's more expensive, I think, than I think one should pay for a truck, especially one that's part passenger car, part truck. It was much more than they had originally said. Also, by that time, I was beginning to think this thing looks a little out there, and it's a bit too flamboyant. Didn't want to show up in something where everybody's staring at you when you pull into the parking lot, and I kind of got the impression that that's what a Cybertruck would be, and so I just decided to go with something else at the time. So, is the same thing likely to happen with the robots? Maybe. It could turn out that way. There is usually a premium to have the first of something that unusual and life-changing. So, if they're saying it's going to be less than a car, yeah, maybe it will be. Maybe it won't be. I don't think that's going to hurt demand. I think people are going to say, depending on what this robot is capable of, I could see people paying up for it. What will it do? Housekeeping? I'm not sure what it's going to do, but if you have a housekeeper, that's probably not that cheap. If you have somebody who does work around the house doing something else, outdoors or in, those things add up. And to have one that never calls in sick, doesn't complain, that seems pretty interesting and exciting. And also the novelty. Who among us is not going to be pretty amazed and interested in seeing that thing get going? I'm looking forward to it. I don't know that I'll be one of the first to get one. I got the second gen iPhone, not the first, and I didn't end up getting the Cybertruck, and so we'll see. But I think it's going to be amazing, and it's going to change the world. Hopefully, for the better, and not in some kind of weird iRobot way. Let's see here. Elon Musk has stated that the long-term goal is to sell the robot for less than 20 to 30,000. Yeah, at less than 20,000, and this is the calculus some people are going to have to get into. When my older son was old enough to drive, and we were debating about, we're going to make him buy a car, are we going to buy him one? Is it going to be a new car? Is it going to be a used car? Ultimately, we wanted the safety features of a newer car, and when it came right down to it, I thought, you know what? He doesn't have a bus that takes him to school. We have to drive him, and his younger brother. We said, well, how much is it worth to us for them to be able to drive themselves where they need to go, rather than having us do it every single time, or get an Uber or a Lyft to do it? Those things add up. So I think the robot math, when people look at this and they say, oh, it's a $20,000, $30,000 luxury item, I don't think that's the way people are going to see it. So Tucker D Dog adds, affordable for average household. I guess I'm not average because I can't picture dropping $25,000 on a robot and thinking, ooh, that's affordable. I get it. $25,000, it's a lot of money. But, the flip side is, it depends what its capabilities are. You might already be spending that kind of money, but you just don't even think of it as such. We do have somebody who comes and mows the lawn, every week and cleans up the yard and does all that other kind of stuff. And these things all add up. So the calculus, it won't be that people aren't going to feel the pinch because that's an expensive purchase, but it might seem reasonable on a relative basis compared to how that money is currently being spent. Or, if it means that you can do things that you otherwise couldn't do. That's, if you get more working hours each week, let's just assume it gives you 5 hours a week, okay? 5 hours a week that you can do whatever it is you do for a living instead of screwing around with something that a robot could do better and more easily and more quickly than you can do it. How much is that worth? I mean, if I said to myself, okay, do I think an extra 5 hours is worth $1,000 a week to me or something like that? Would that seem reasonable? Yeah. Great White Shark says 25,000. I've got 30,000 ready for my robot. Yeah, I mean, it is very easy for me to see how a household would federal tax code. I like this Black Mutt video. Federal tax credit for robots now. Call your congressman. Well, first of all, to the extent that we want the United States to be positioned for leadership in technology and robotics in this specific instance, if we're going to offer incentives for anything, this might not be a bad place. I mean, I would ask this. Would we rather have U.S. robots in everybody's house or Chinese ones? And this is not, I think it's understood that there is a little bit of a strategic risk associated with hardware and technology that we come to depend on coming from another place, and where some of the information or data that these machines are capturing is sent back to the mothership. Where do you want that mothership to be? I'd rather it was in the United States personally, but I suspect seven-figure mission. The robots may appreciate in value a little different from cars. Maybe. I'm guessing that the cycle of evolution is going to be quite rapid, and so it is. I don't know that they will appreciate necessarily, but, and I'm sure you guys saw this, that over the course, I think it was over this last weekend, that China had a humanoid robot that ran a half marathon, and did faster than any human did. But the way I would look at it is not that it's going to appreciate. Black Video said it's technology, no chance it appreciates. New versions, we'll keep putting them out. That could be, but I will also say that it can make financial sense to buy depreciating assets that have economic utility, right? So, trucking companies can buy trucks with the expectation that they will essentially go to the graveyard at some point, not be useful, as long as the economic benefit outweighs the economic cost, and then I can see the purchase. And in this particular instance, I could see these things justifying the purchase price quite easily, and sooner than you might imagine. I can imagine. Think about how ubiquitous a dishwasher is, or a washing machine, or a dryer. And now imagine you have machines that can do so much more than that. That's going to be quite valuable to the human experience, both in terms of quality of life and also from an economic point of view. So, quite profound, I suspect. All right. Actually, let's just, because we're almost out of time, I'm just going to take a quick look, see what else is reporting this week that's probably well worth a look. United Health. So, one of the areas that got really hard hit was healthcare, and it has not rebounded. So, what is it? Let me think. Is it XG? Is that, that's, which one am I thinking about? XLV, right? XLV. Here we are. So, United Health and Humana were a big part of the reason why this sector sold off as hard as it did. And, this is one of the sectors I was looking at that is well below the highs that we saw earlier. Now we are about midway between the lows and the highs for the year. And so this is an area that I thought might be interesting. And now we've got United Health. They're going to be reporting this week. United Health was trading well last week because we got new reimbursement rates out. And the previous ones, those of you who've been following the space probably know, were very poorly received. Last week's a little bit better. I think if you get back down in and around the 144 level, which is not far off of where we are, you can see that's this level right here. We come into that, I think that's probably kind of an intriguing just sector allocation bet. Something to look at ahead of United Health. Okay, so with that said, I have chewed up a solid hour of your valuable time, and I certainly appreciate you giving it to me. Like, subscribe, put your questions into the comments section on the YouTube channel for the video itself, not the chat, because otherwise I have to rewatch the video to get it. But if you put it into the comment section for the video, then we'll see those questions, and we can revisit your questions in a future episode. Haven't spoken to Mark Guthner about whether or not we're going to be able to do office hours tomorrow at 2. I hope we will. But if we aren't, be sure to tune in on Wednesday at 4:15 Eastern for another open mic. Thanks for watching.